Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com takes a look at the major markets. Little investors going after big hedge funds seems to be the flavor of the day. Could silver be their next target? Editor of the newsletter RicksPicks.com, Rick Ackerman, jumps into the Robinhooders versus the hedge fund debate. He says it just goes along with the craziness we've seen in the markets. He also comments on the U.S. dollar and gold. Publisher of the realestatetiming.com newsletter, Robert Campbell, checks in from San Diego to talk U.S. real estate and how people are abandoning New York and California. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Well, another one of those shocking weeks. How many of these can we have in a year or two?
Well, just this year alone, it's been interesting, and we're not even out of the first month.
Yeah,
Ross,
and a year ago today, who knew what COVID was? I mean, that was a word that wasn't in anybody's vocabulary. And 2 weeks ago, who knew what GameStop was? Did they know that it even traded? So, here we go. The small man on the street, the fellows confined to their at-home offices with their computers and frustrated with all that's going on, ganged up on the big boys. And, it's interesting. I think that this really is something that deserved to happen. Over the years, when I was employed in the industry as a financial advisor, if we wanted to go short a stock, we had to get a hold of the lending post and get approval. They had to make sure that they could borrow the stock so that in turn I could go out and short it. And, it was only if the stock was held in margin accounts that they were even allowed to do that. So, here you are, the public can only short with some very specific rules, but these hedge funds, the dollar amounts that they've been able to do and the percentage of a company's float has just been totally out of hand. So this, the squeeze that has happened here, it's for the record books. I think somebody said you got to go back to 1902 to find one like this, but this is. It clearly is going to be a game changer. And the shame of it is that they won't just come up with legislation to control it. They will come down with too big a hammer, and that's invariably what the regulators or once the politicians get involved with it, they'll go overboard.
Germany banned short trading after the recession in 2008. Could we see the same thing happen here?
Well, see, there's nothing wrong with short selling. As I say, if you can borrow the stock, that's one thing. The other thing you should have is you have the uptick rule. I mean, that used to be around years ago. You couldn't just continuously force a stock down. You could only sell it if it traded up. And so that makes sense. There are too many of these companies that are just being totally driven down. And you do need the short sellers because at the bottom of the market, when things fall out a bit, they're the people that come in and buy. In 2008 and 2009, most of the public, unless they were just pure value players or dollar cost averaging, they were scared to step in. And it's the short sellers who were able to, they were buying along with all the liquidity that was being put in by the various central governments, banks, that put the buoyancy into the market. But, I'm one for free trade, or free trading. Let the markets find their own levels. You'll have the volatility within it. But when you get abnormally large positions, on one side or the other, and then the trend starts to work against those positions, it's the margin clerk who has the greatest amount of control, and they're going to force you to cover in the position or come up with the cash. And in this case, you've got some big funds that are either going under or they're going to end up merging. And hopefully the government doesn't step in and try and bail them out in some way, because that would be totally unfair.
Well, apparently we did have a big bailout, and do the hedge funds have the ear of the government to the point where they'll still rule the roost and screw the little investor?
Well, it's I've seen exchanges do things over the years. Back in 1979, 1980, when the Hunt brothers got involved in the silver market, and it ran from $12 really effectively to $50. In the process of that move, silver, other than the spot contract, which was always available for delivery purposes, so you could take or give delivery of the 5,000 ounces of silver per contract. Other than that spot contract, all the others have a limit price in terms of how much they can move in a day. So they've changed the rules now, so that limit does expand as the price gets locked limit on day after day. But back then, it was locked limit, and it could only move $1, $1.50 a day. So as the prices went up, we were limit bid for 9 consecutive days. And the exchange, and the only way that you could trade it, and we did for the 3 weeks running up into the top, was that you would sell the January contract, because we were into the month of January, and that then meant that that was for immediate delivery. So what you would do is then a second trade, and you had to do this within the same day, where you would then buy back the January and sell the March as a spread, because the spread always traded at the realistic level of the carrying charge between the two. So you would effectively end up selling your forward contract, the March was the active one, at the high level. Just prior to the top, the exchange came out and changed the rules. And they said you could trade for liquidation only, which meant that you couldn't use that January contract. You couldn't trade into the contract so that you could then spread out of your March contract. And so what ended up happening is, even though silver got up to $50, the futures contracts only got up to 41.5. And we had clients on the top couple of days who were trying to get out and get that $49 to $50 price that we were trading up to. But they weren't allowed, because of the rules that they had changed. And so nobody who traded futures ever got a $50 price on silver. If you were trading in the cash market, you were dealing with a dealer, a cash dealer, fine. But nobody who traded futures ever got $50 an ounce. So the exchange does what it needs to do to protect the big boys. And it was the big boys who were caught short. It was the punt hunts that were pushing the price. But the insiders, as far as I'm concerned, within the financial community there, were they were out huge amounts until they changed these rules, and then we had consecutive limit down days. So the big boys managed to get out of things nice and clean.
What's going on with the precious metals?
Well, the guys, the Reddit guys and Robinhooders decided middle of the week that they were having so much fun with these other stocks that they would put the silver on the list. Over the years, literally over the decades, the silver bulls have always talked about the shortage of the product and that there would always be a squeeze. And I've heard this story for decades and decades. But at this point, the speculators are now getting on the bandwagon and saying, "Oh, we can do this to silver. What we'll do is we'll buy the SLV, the ETF, and we'll force it up." Well, I took a look. There are 560 million ounces of silver that are in that ETF. It's not all cash. It's mostly the actual silver product. And there's only 13% of the daily trading volume that's actually short. So there aren't a lot of shorts to be run here as far as the SLV is concerned. But it's been enough to give silver a pretty good prop on the week. We ended up with a good run up into 27 and change, closed off the week back around 27. But it will be interesting to see how much they can squeeze this market right now. For all that silver had a pretty good week, gold didn't do much at all. And I think on the week there on Friday, it was only up about $4. Silver was up close to $1. But I'd be pretty leery about having positions there. If there's one where you need to have a stop, it would be right in that market. Because as I say, the exchange has been known to change the rules, and the squeeze might not be as big as some think it can be.
Anything going on with crude?
The crude oil, well, we punched up through the $53 range. I think it still looks a little tired up here. I've got to be honest. I mean, there's a lot of these markets that have moved more in the last week or so than I ever thought that they would. Personally, I thought that we would see the oil market work its way back down into the high 40s. I still think there's a distinct possibility of that. I'd like to see it get down a little more oversold than we've seen right now. And we take a look at things like the U.S. dollar, which bottomed out the better part of 2 weeks ago now. That one is slowly grinding its way higher. The index is around 90 3/4 right now. I think that can get up close to 92. And if there's that kind of buoyancy over in the U.S. dollar, that puts a bit of pressure, I think, on oil, and it puts a little bit of pressure over on the Canadian dollar as well.
Ross, thank you so much for chatting with us.
It's always a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Rick Ackerman next on This Week in Money.
Always consult your investment professional before making any investment decision.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Rick Ackerman, editor of Rick's Picks, available online at rickackerman.com. He's speaking to us from South Florida. Rick, welcome back to This Week in Money.
Thanks very much for inviting me on, Jim. I always enjoy our talks.
Rick, what's the latest at Rick's Picks, and how can people subscribe?
Well, we are doing really well with the trading. The chat room draws great traders from around the world, and we're using what I call mechanical setups to get into stocks that are going nutso. So So we're having a pretty good time with all the big movement in Bitcoin and all the nutty movement that's coming from these social media discussion groups. So if you want to get in on the action, just go to rickackerman.com and click on Start Trial up at the top. You'll get 2 weeks for just $1 of all the things that I offer.
What made headlines over the week was the action on the message boards on Reddit and the bumping up of the GameStop stock to ridiculous levels. Do you have any comment or idea what happened there? Was it the revenge of the basement day trader against the hedge fund managers?
Not even. I mean, I think that's a nice story for the financial tabloids to have concocted, but it's in no way the truth. What it is that the little twerps who are out there on Reddit, it's like a 5-year-old kid discovering where daddy keeps the matches. So they discovered that this power that they have to move stocks merely by training their crosshairs on stocks where the short interest is a relatively high percentage of the float. So I think that to the extent that it's become the singular obsession of the news media, that the main part of the trend, the exciting part, has already played out.
Does this tell us that people should be aware that this could happen to any stock and you have to be careful?
Yeah, I think most people don't have to be told that because most people don't short stocks. But the hedge funds do, and they can certainly look out for themselves. And I would say when I said that the trend is over or it's just about spent, even though the Reddit guys don't know it, is that apparently their latest target is Citadel. And I think that just the very name Citadel conveys metaphorically this idea that the Reddit guys are going to attack and beat into submission the literal buttress of capitalism. You know, Citadel's up near the top of the chain, really, in terms of the financial hierarchy and all the players. But trust me, Citadel is not exactly trembling in its shoes, even though they've seen Stephen A. Cohen, SAC fund, take quite a hit. But for all those guys, they're sort of like gnat bites, even though, yes, there will be some long-term changes that come from all of this targeting of shorts.
The Dow topped 31,000 points this month. What do you see ahead for the Dow?
I think we're in a bear market now, and I know that I've made that call a lot of times without much success since the early 1980s. You know, that's what a perma bear is, and we've certainly caught a lot of good tops, made money shorting, let's say, transient tops, but I think we really have topped. It's partly because I've got some targets that have been hit very precisely, like IWM, which tracks the Russell 2000 small cap stocks. I had a target out there from a while back. We got within 9 cents of it and came down pretty hard, and it still hasn't been taken out. So from a technical standpoint, I see a lot. The NASDAQ also, I had let's see, I think it was a 13,555 target, and I missed by a split hair on that. So I'm seeing the big indexes hit long-standing targets, but I also think that the background, the climate, meaning that we've had a radical political change take place, is just perfect for a bear market to unfold. And the psychological backdrop there is, hey, you know, Biden won, and now things are smoothing out. He's basically in charge, and we can get on with business. I think that business, regardless of what you fear from the agenda of the Democrats, they're going to be too busy trying to deal with the second Great Depression to implement a lot of the scary parts of the Democratic platform.
More states are opening up from draconian lockdowns. Could that be good for stock markets and the economy?
Not even slightly. You know, the one of the biggest things, I don't think we can have positive news on a vaccine for at least a year and a half. In other words, a point where we look and say, hey, we really beat that virus. Between now and then, what we have are going to be stories about people dying or getting weird symptoms from the vaccine, or the vaccine doesn't work, or you need constant booster shots or whatever. So I think the odds of bad virus stories over the next at least 1 year are much greater than are seeing any sort of epiphany about how well the vaccine is working. So as far as people getting back to work, and we've talked about this before, the infrastructural damage, the huge write-downs that have yet to occur that were much more significant than the jobs picture, they're still there. I mean, New York City has to write off its office buildings and its transit system and its the cabs and everything else. And these are bigger hits even than the one we've got to take from the mall infrastructure. All the shopping malls in America are going to have to get written down and written off. So we have these enormous write-downs of capital, and when you put it down to the level of not the macro but the micro level, the New York transit system, the construction and maintenance are financed by revenues from users, from commuters, and we're never going to see commuter levels return to anything like what they were, so that all of the bonded indebtedness that came about as a result of the construction and maintenance of these systems is going to be it's going to take a hit. And you could even look at another part of the hit. The person behind the bulletproof glass that sells you subway tokens, assuming there's still any human beings left in the transit system working there, their retirement package is worth something like, I think I read, $90,000. So all of those costs have to be serviced from presumptive revenues from commuters. So these are huge numbers. And when we talk about people getting back to work to whatever the new normal is going to be, which will be a greatly reduced economy, the transit system, air transport, concerts, all the stuff that we do, forget about the vaccine and people getting back to work, because even if things get completely as cranked up as you can imagine them, the economy's going to be running at like 60% of what it was at best.
And with so many people bailing out of big cities and moving into smaller towns, what about all those little mom-and-pop shops, boutiques, coffee shops that relied on the office traffic over the noon hour and just after work? Are they ever going to come back?
Yeah, that's all part of city infrastructure. When the office towers are not filled with workers, the places that provide lunch and dinners and drinks to those people are all going to die. So that's going to happen regardless of whether Cuomo and de Blasio finally loosen up. There's no way to save all those restaurants. They're dead. It's unfortunate. New York was a great town, but it's not now. And you could say the same about San Francisco, where I lived for about 22 years. So the migration has very significant implications. Moved to the suburbs. I read a review of a couple women who said they've been studying the migration for 20 years, and they're talking about all the wonderful things that will happen in the burbs, and that the way that suburbs function and that the amenities that they offer and the types of housing that they have will have to change to reflect this migration. But these women missed the broad side of the barn that they themselves built, because the migration, more than anything else, is driven by, they mention this in passing, but it's really kind of a spreading out of the impoverishment of America. Nowhere in this article, which summarized the points of their book, did they mention the economic changes that are taking place. They're talking about all the wonderful support groups that will exist out there in the suburbs, but they never even deal with the economics of it, like where these people are moving and they're going to have different clubs that they can join and this and that. But what kind of jobs will they have? And the answer is they won't. And that's part of the, robotics is displacing quite a few jobs. And so I think that an important aspect of the migration to the burbs is that it's going to spread city poverty or city subsistence out to the suburbs. It's really just kind of a broad measure of how America's standard of living has really declined, notwithstanding the fact that we can all have 60-inch LED TVs on our walls and drive more car than we can afford.
More people are becoming aware of rigged markets, rigged elections, and a complacent media. As this awareness grows, could markets become more volatile?
Well, that's already happened, and it's happened to an embarrassing and probably fatal extent. You know, the regulators are really embarrassed about what's happened with the social media groups driving these short squeezes. And even though some of the politicians get all excited about it, there's nothing, I won't say there's nothing they can do. There's always a regulation that you can create. But by and large, the Reddit guys they're not doing anything illegal. There's really no legitimate way that you could stop them. And of course, targeting shorts is nothing new. It's just that we've never experienced that phenomenon with the existence of a social media network that gives a relatively small number of people a big voice and quite an amplifier for it. So yes, things will just be crazier. You could put it down to a bottom line that we're living in, unfortunately, very interesting times that continue to get even more interesting.
Yes, the old Chinese curse, may you live in interesting times. Is it really Robinhooders versus hedge funds? Is it that clear?
Not even. As I said, I think that's just the kind of story that the financial tabloids dream up. But the hedge funds, believe me, they'll be able to cope. And for the little Reddit twerps to think that they're somehow changing, that they have changed the game for sure. And it has to do with the fact that even though the big players are not exactly shaking in their shoes based on some post that occurs on Reddit, they do have to take into account that if their short interest is out there in the public domain, that they can conceivably get targeted. So it's going to change the game. It's going to reduce the amount of short interest overall. And even though this isn't being commented on the talk shows or whatever, on CNBC, Bloomberg, the bottom line is that when short interest begins to shrink, it's going to change the nature of the bear market that's coming, right? Because in a bear market, short covering is it's a major importance in propping up the market. When you talk about buying the dips, who do you think's buying the dips? It's short covering, quite a bit of it, and that's not going to be there. So that when the bear market comes, which it will, the decline periods, it goes down, will probably go unrelieved to a greater extent than we've seen in the past. The downtrends are going to last longer. They're going to seem more relentless. And the exhilarating rallies, the short squeeze rallies that exist just to prevent some of the idiots that appear on these talk shows from guessing that we're in a bear market. You know, that's the function of a bear market rally, is to let all the chimpanzees say, hey, see, it's not a bear market. Prosperity is right around the corner. Well, those rallies are going to be less convincing, less spectacular. So this is going to alter the dynamic of bear markets itself. Even though, as I said, the Reddit guys, they overestimate their power and and even the consequences of what they're doing.
After the last recession in 2008, Germany banned short selling on their stock markets. Could you see the same thing happening here?
You know, they've done that in the past, or they fiddle with the rules. You can't short downticks, but now I think there is no downtick rule anymore. So in a way, the rules against shorting have kind of loosened up over the last 10 or 15 years. But to ban short selling outright, I don't know. It serves purposes beyond companies simply trying to make money from falling shares. You know, there's a lot of short interest out there that relates to arbitrage arrangements and people making money not because they're bearish on a stock, but because they're able to put things out on loan and pay a differential in interest rates. It costs them to borrow the stock, but they can make more in some other way. So I don't know. It's almost like if you look at shorting and think it's like mosquitoes. Who needs malaria? But it turns out when you wipe out all the mosquitoes, you destroy part of the ecological chain with consequences that are hard to predict. So I would say don't write off all the shorting. Regulators can always do the wrong thing and do something stupid, but I think that the shorting itself is going to have to remain.
Do big tech, big media, big pharma, big banks, big government, big brother add risk in the markets for investors?
Well, yeah. I mean, because the whole shoddy edifice of global finance, it's just a big carnival midway game. So the big players obviously are in it in a big way, and they're all foolish enough to think that things are good and that the stock market deserves to be trading where it's trading. A lot of people actually believe that. They don't really consider that the stock market's trading where it is, and some homes sell for $30 million or more in LA simply because the Fed has put all this credit in play. And, the chimpanzees that run the money, the money managers, they all get credit for being geniuses, but it's not. There's just so much money to throw at the market. They throw it at a handful of stocks, and they go up. And we know that when they add their own discretion, like which stocks should we buy, that none of them can beat the indexes. So the stock pickers are all. It's all a shabby game, really. And so the big pharma and big everybody else, they're more in the business of shuffling paper and doing things that they teach finance students at Wharton. But how do we know that that's their main business? Because all of the real goods and services on this planet only add up to whatever, it's something less than $200 trillion. But the notional value of these financial markets, leveraged instruments in what we loosely call a derivatives market, they add up to something like $2 quadrillion. So why do we need a $2 quadrillion financial edifice to support a global system in real goods and services, global economy and those things that's only 1/10 the size? So all the big players, screw making things, getting their hands dirty on assembly lines. The big money is just in shuffling paper.
We'll have more with Rick Ackerman when This Week in Money returns.
Ackerman Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Ackerman's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at ackermanresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Rick Ackerman. Rick, does the U.S. dollar look like it has bottomed for the short term?
Maybe. I don't think so. Actually, I was looking at charts, and as bullish as I am long term on the dollar, I can't quite see a turn here on the charts. It's got to go lower. But when I say I'm bullish on the dollar, the reasons are very counterintuitive, but they go along with the deflationist theme that I've been sounding for the last 40 years. I think the dollar will strengthen, if for no other reason, because everybody needs and expects the dollar to go higher. There's so many bets really based on being able to pay back debt in cheapened dollars that we've sort of spring-loaded things to go the other way. So as counterintuitive as it seems, especially with the Federal Reserve on a credit stimulus binge, I think deflation is the end game, and it's really the destruction of the inability of people in the chain of debt of business entities, of borrowers to pay back. And so the hallmark of deflation, forget about what the monetarists say. Well, inflation is more dollars and deflation is fewer dollars. It has nothing to do with money supply, because we can't even measure what money is anymore. There's so many fungible forms of money that people who get wrapped up in monetary theory are just headed down a blind path. So we have all this credit that's been essentially leveraged out of real assets, but there are very few of them. There are very few real assets. One is energy and the other is food. And the good news for people who think, you always hear about how they are going to collapse the system, and the rich guys will walk away with all the goodies. They're going to take everything we own, and the rentiers and robber barons are going to own everything. Well, the good news is there's not going to be that much to own, because if you look at what would be misconstrued as wealth these days, all this supposed wealth of the planet, if you subtract out what's owed, there's nothing left. So the best that the supposed masters of the universe can come away with is good farmland and energy resources. But it's tough to make a buck with farmland. It's no coincidence that Gates is the biggest farmland holder in America now. But it'll be harder to make that buck, certainly to make leverage bucks with the energy patch, if the world is in an economic funk. So all the all the wealth that supposedly will be essentially expropriated by the ruling class, there's going to be a lot less of it. I don't mean to suggest that there won't be enough of it around, that they will not be driving Bugatti Veyrons and building homes with 12-car garages. There's even in the 30s depression, there was enough money to be flaunted, but I think it's overestimated as to what the ruling class is essentially, and the conspirators and the Davos gang and all those, what they stand to gain if they shake down the system.
How is the Canadian dollar looking?
Well, it's always been a resource play, and I think that sort of gives the Canadian dollar a kind of bedrock anchor. It can only be so bad. It's almost like looking at gold. Gold may not go to $50,000 an ounce, but as I've always tried to point out, it's going to hold up very well with respect to purchasing power versus so many other types of assets. But so I guess you have to like the Canadian dollar, but you also have to notice that the big reset rally that's occurred from the March 23rd low in Canadian dollar has not quite had the zing of the rallies in the NASDAQ and the IWM. It's not a supercharged vehicle. It's had a big move, but it's still, the Canadian dollar at a current 78 cents is still sitting well below the high that was reached in February, up around 82 cents. So it may have maybe just about ready to give up to expire without having made new highs, which means that I would expect the Canadian dollar to come down again.
Gold's been trading in a range since hitting new all-time highs. What do you see ahead for gold?
Well, as much as the sleazeballs who make their money shorting gold, paper gold, creating paper gold, borrowing gold from the U.S., as much as we'd like to think they're in charge, market forces that are pushing gold higher are really, they're the dominant force. We see occasional days when gold and silver get hit so hard, well, those dumps are really created to give a little relief to people, to business entities that make their money borrowing gold. So So it looks pretty good. I mean, we've got as I look at the weekly chart of, this would be the March COMEX contract. Let me give you, I haven't even put this out for my own subscribers, I don't think. But as I look at the chart, I could see, COMEX gold going as high as $2,400. The key price it's trading $1,850 now, and I'd like to see it get up to at least $2,100. The exact number is 2086 before I think it's in a condition to challenge that $2,400 benchmark that I just gave you. But I like gold, and I think that again, even though it's not, I don't see it going to $50,000 or even $5,000 an ounce. It's still great to own.
Silver's been on a trading range since approaching $30 an ounce. What do you see ahead for silver?
Well, just over the last week, silver showed a little more relative strength than gold. And even though I was tempted to say they're going to stay in a doldrums forever, silver just poked through a small but technically significant threshold that gave me a current target. This is basis the March COMEX contract of 28.39, which I predicted would get hit by either maybe Monday or Tuesday. So it looks pretty good. I would take that 28.39 number, and that's what I call a hidden pivot resistance. And if we see silver pop through it pretty easily, it would be bullish going forward. It would mean that any pullback is likely to be corrective for another move up into the 30s.
Where do you think the mining and junior mining stocks are headed this year?
Well, they're just such great values, but they are going to have to wait and see what the, what the significance is of mining companies and gold production in a depression. So they always love to sort of hedge their bets with forward selling of whatever the mines produce. But I think they're going to have to sort things out. Deflation is definitely good for the bottom line of these gold producers, to the extent that we're going to see fuel prices depressed and some of the energy inputs that go into mining, the cost will be somewhat reduced. But ultimately, you need demand to really drive things higher, not reduce costs, and that remains to be seen. There'll probably be a lot of consolidation, as there has been in the gold industry, bigger players taking over weaker ones, or companies that don't really have the funds to ramp up production. So anyway, I think I don't expect a kind of breakout move of the gold miners. But they look pretty good. And relative to many other sectors, I think you'll get good performance from them over the next year.
What's the latest on interest rates?
Well, they can't go much lower, and they're finally starting to respond to market forces. More people perceive incipient inflation, and I think they're within a pretty close distance here of going out of control where the Fed is concerned. The Fed has maintained this illusion that they're in charge, but all they do is kind of make it up as they go along and just hope everything goes their way. And it does in large part because there's still a lot of chimpanzees out there who believe what the Fed does, and they're respectful of what these charlatans do from 1 week or 1 month to the next. So eventually, market forces are going to claim the central bank as one of their victims. You can only hold the line on interest rates for so long, and we've already seen the failure of Fed policy already, the initial phases of huge failure, because stimulus no longer stimulates. All they get from stimulus is asset inflation. And the theoretical idea behind stimulus is you ramp up the economy enough so that all the debt that you've incurred stimulating can be paid back. But nobody on earth could possibly believe that's going to happen anymore, that we're going to go into some strong growth period that's going to take the many trillions of dollars that have gone onto the Fed balance sheet and allow us to pay those debts down. So to the extent they're unpayable, they become unpayable. That is an inflation component. It's got to happen. But what I continue to say, to put out there, is that the deflationary juggernaut is much, much bigger.
What's happening with crude oil?
It's enjoyed the fraud that's occurred since March 23rd. The idea is practiced by the powers that be that we got to keep oil prices up. So, it certainly hasn't been huge global demand that's powered crude from the lows back in March up to north of let's see where crude is trading right at this moment. It's 52. So it's been as high, a little bit higher than that, and we know it's not demand driving that. It's just the fraud of global finance and the absolute urgency of keeping crude prices afloat. Why? Well, when we came out of the housing collapse of 2007 and 8, all the smart guys, they so to speak, put their heads together and they said, well, what can we hawk up to our eyeballs? And the answer was, let's build another daisy chain of hypersonic wealth from oil and energy resources. So that's what's happening. A lot of the leverage that powered us out at the 2008 bottom has been extracted from productive from energy resources. So I have to give them credit for manufacturing a hoax that has pushed this enormously available commodity from a low back in March of $27 to a current that they've doubled the price of it practically. And that's pretty good considering it happened in the absence of demand, only on that pass and the prayer story about how the world's recovering and China, the big marginal buyer of energy, is going to put some upward pressure on prices. Well, we're at 55. I think maybe 30 would be a more realistic market price for crude.
Are you watching the green energy market?
Green as in let's try to produce energy without, we don't have the resources, the capital really, to make that conversion. Let's take the hypothetical example, like everybody puts up solar panels and wind generators tomorrow. Well, it takes a huge investment to do that, and even countries like Germany have really not found a way to make it very economical. It costs them a lot of money to generate power, and I think with the world going into a synchronized downtrend, a depression, where will the capital go to make this enormous conversion from readily available carbon-based energy resources to wind and solar? So I think that the political muscle to force that essentially a tax on the world is there. It's going to be there. There's certainly the will to do that, to turn everything into a giant wind farm. But I think that it butts up against financial realities that are going to make the pace of greening the energy resources much slower than people seem to imagine.
Sure. The province of Ontario went on a green streak, and all that did was dramatically boost electricity prices to the point where people now have to decide, do I heat my house or do I buy food? Right.
And you get to make that choice tomorrow as a life or death thing if hypothetically everything in AOC's platform, her energy idea gets implemented in toto. It won't be, but even just a small piece of it is a threat, and essentially something that could cripple any hypothetical recovery of the economy.
What's the latest on the agricultural markets?
Well, I mentioned farm products as being of the two things that have any value on this planet economically. One is energy and the other is food. So it's always been hard for the farmers to make money, and no less so with agribusiness. You know, the margins are relatively small, but I think the most promising trend there, I guess you could call it a little bit of greening, but more and more organic stuff is showing up in the supermarket. And all I can say, speaking for myself, I'm paying $7 for a dozen eggs these days, but consciously with the idea I want to pick the best eggs with the yellowest yolks that I can find, and I think people are starting to pay up for organic produce. It's giving the farmers a little more room to move. They can see that the margins are there to grow organically, and I think that promises some relief for the farmers. But as far as, well, let's say inflation in in agricultural commodities, it's part of the excess that we've seen of the dive into assets, tangible assets, resources that's occurred since March 23rd. So in that respect, wheat futures are kind of an inflation hedge, but I think it's been somewhat overdone.
What sectors are you keeping a close eye on?
Well, I like the dismal sectors. You know, I think that when deflation hits full bore, that you need to be in places that are hardly yielding any return at all. Part of the main reason the collapse is going to occur is that every single investment fund on the planet has been stretching for yield so that the portfolio has Bolivian reverse floaters in it, just so they can coax an extra 1.5 basis points from their portfolio. All right, so I think you really have to look in earnest at things that look like crap right now. You know, things you say, geez, why would I ever put my money there? Anything that's been sort of bought as a value story since the March collapse, it's already pretty overdone. So it's sort of self-defeating to think you're going to go out there and shop values. But ultimately, I think that's where you need to look, even at the current price levels. One would be utility companies that pay dividends. You know, they're always going to be allowed a decent living, so to speak. So that's not a bad place to go. But I'd watch out for companies that I can never see the dividend play, because, you know, people will jump into a stock because it pays a relatively exorbitant 3.5% dividend, but they're unmindful of the fact that 3.5%, the stock could be down 14%. You know, you could lose 4 times the dividend in a bad week on Wall Street. So I think dividends are somewhat illusory. A lot of the bombed out plays like the cruise lines and the airlines, I think that there is no bottom for those stocks. And it's amazing that some of them have been bought up the way they have. It started, of course, with the craziness that piled into Hertz Rent-A-Car. But you know, some of those things, there's really no bottom for the airlines and the cruise lines. They may be on their way out of existence. And I see, you know, Florida supposedly has got a hotel boom going on right now. That I can't figure. I guess you got to give the big money that builds hotels credit for being optimists no matter what, but that ain't the place to be either. So all the recovery, the vaccine recovery stories, they've been bought to death, so there's no value there. You just have to look at stuff deliberately with the idea, why would anybody want to own that? And that's exactly what you want to own.
Rick, where can people find out more about Rick's picks?
Well, if you go to rickackerman.com, that's where Rick's Picks exists in cyberspace. And at the top of the page, there's a button that says Start Trial. If you click on Start Trial, you get 2 weeks of everything that I offer for $1. And the best place to start with us is come into the chat room. I've got 2 of them. One is called the Coffee House, where the discussion is loosey-goosey, and the trading room, where the discussion tends to pivot on tradable ideas. So again, that's rickackerman.com. Just click on Start Trial, and you'll be right there. Just be sure to say hello when you come in the chat room.
Rick, thank you so much for being on This Week in Money.
Well, always a pleasure, Jim. I enjoy getting it all out there when we talk, and thank you for your great questions.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website rickackerman.com. He was speaking to us from South Florida. Coming up, Robert Campbell talks U.S. real estate next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.ZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Robert Campbell, publisher of the realestatetiming.com newsletter. He's speaking to us from San Diego. Welcome back to This Week in Money, Robert.
Thank you, Jim. Always honored to be part of your show, and always love talking to you.
Bob, can you tell us a little bit about the realestatetiming.com newsletter?
Yes, that's my area of expertise, everybody. I time real estate markets, like 25 major housing markets in the U.S., like people time the stock market. Except my advantage over them is real estate. If you know what indicators to follow, real estate's less volatile and easier to do. So I've had that website for 19 years, been writing a timing letter for 19 years. I wrote a book about it that shows everybody exactly how I do it. Nothing's changed in 19 years. It still continues to work fabulously, and it's a real joy that when you can have 3 to 6 months worth of lead time to major trend changes in a market, in the housing market, and because that's how you get ahead in life. You know, you got to buy low, sell high. That's the golden rule of investing. Look, there's that long term, there's no question about it. Real estate will go up. Of course, that's on a nominal basis. When you start adjusting for inflation, that can be a different story. And those are the lot of things I like to do because the cycles become more apparent. But for example, here in California, when we had high inflation, when inflation got up to 13% in the United States, real estate prices in San Diego only fell on a nominal price basis, like 12 to 15%. But when you adjusted for inflation, they fell 30%, which is a big difference. That's purchasing power, right? I mean, you could say, oh yeah, I mean, it's not about getting your money back in nominal dollars. It's getting your money back in purchasing power dollars that are greater than you had before. So that that here in the United States, when you adjust for inflation, Jim, the average price house over the course of the last 130 years has only gone up 1% more than than inflation. Whereas the U.S. stock market, for example, to give you some comparison, that's gone up 5.5% above the rate of inflation. So from a pure non-leveraged investment standpoint, the stock market is 5 times better than U.S. real estate as far as real price appreciation.
Sure, and people say, oh, real estate nowadays is less affordable than it was 30 years ago. Well, back at the end of the 70s, interest rates were 18-21%. Now they're almost zero. You tell me what's more affordable.
The only thing that saved the real estate market back then, and I don't know if you remember, at least here in the United States, we had what's called a Wellenkamp decision that said all past loans were affordable. So on the way to 17, there was mortgages at 10, 11, and 12% that were assumable at those interest rates, and the lenders couldn't do anything about it. So that's what supported the housing market. Housing shot way up, and when you sold your house, they would take over the existing low mortgage rate, and you take back a second. So housing prices didn't fall that much. So every cycle is so different. Every cycle is so different. But all in all, the stock market is a better place for your money than real estate long term. But what I don't like about the stock market is the volatility, and that's the dirty little secret nobody tells you about. That about once every 10 years, your equity drops by 50%. And you go, oh, I'm just going to sit tight through this because I know it's going to come back. No, you don't. Does the average person do that? No, he thinks about jumping off a 20-story building.
Hedge funds can attack a company's stock price, destroying the company, and the powers that be don't care. But when investors, traders, also known as Robinhooders, cause a short squeeze on the stock shorting predators, all kinds of barriers and regulations are brought in to protect the big money that is short. Could times be changing in the world of shorting? And this is all connected to the Reddit message board that had people trading GameStop, boosting its price from about $1 a share to over 400. And then the hedge fund had to, yeah, it was which?
It rose to 500 in before market trading, U.S. trading.
Yes, and it's a company that's basically worthless. It's another.
You know what it's worth fundamentally? Like $2.
Yeah.
Do you think that's a little frothy?
And should the hedge fund that got bailed out because they lost a fortune, should they be bailed out for being so stupid?
No, of course not. But that's not the way the world works. If you're rich and lose your ass, you get bailed out. If you're an average American and lose your ass, you lose your ass. And that's just the way the world works. Is that fair? No, it's not fair at all. That's why it's more important for people to take control of their own financial destiny. And they have to make adjustments on their own. You know, and not because the government's not going to bail out. You got to take care of you. It's like my dad when he was fighting in the South Pacific as a Marine. Okay, they had air support from the Army Air Force and Navy support from ships. Do you think those Marines on the ground counted on those two guys to save their ass? No.
No.
It was like us or the enemy, right?
Marines relied on their M1 Garand semi-automatic rifle.
Right. They weren't counting on air support. You know, if all of a sudden they were stupid and moved into an ambush or something, you just don't do it.
I talked to a Marine in the Pacific who said he got bombed by his own Air Force more often than the Japanese.
Oh, my dad had a story about that too.
Yeah.
And he said a plane was coming in, and they thought they were Japanese, the enemy, and they started shooting at them. And all of a sudden, my dad and a couple of the guys stood up, and started waving their arms like, no, no. And I said, get the hell down, Soupy. They called him because it's Campbell soup. Get the hell down, Soupy. Just, try not to get yourself killed.
Could the Robinhood short squeezes be the start of a stock market mania? And does it tell us that things are just too toppy and frothy to really trust?
I take the too toppy and frothy. I think that the odds are high that, even though overvalued markets can get even more overvalued, but I'll say this is a sign of the times. When you see GameStop go from $2 to 500 in what? How long did that take? A week? Didn't take long. I mean, it's pure speculation, rampant speculation. I would think that you would have better chances going to Las Vegas, and either going on it, go to the craps table and put all your money on, don't come. One bet. I would take my chances with that versus this kind of crap. I mean, this is something, and it's purely speculative enthusiasm. And it happens over and over and over again throughout history. Until they repeal human nature, Jim, this is going to continue to happen.
Yeah, exploit greed, exploit fear. You'll never lose.
Yep. If you can get out of the way of it. But you have these swings where, like GameStop, I saw it in the morning when it was up at 500. It was up like 100%, and then half an hour later it was down 50%. How much of that do you want in your portfolio, retirement account?
Joe Biden was inaugurated president, yet there are still election fraud cases in the works that could prove the U.S. has an illegitimate government. President Trump still has not conceded. Could this kind of uncertainty lead to volatile markets ahead?
Oh, absolutely. Absolutely. They could lead to social unrest and violence where, or they could lead to a, I'm not a conspiracy theorist by any means, but all of a sudden there's 70 plus million Americans that supported Trump and think they were cheated. If they all start getting together, I think the biggest way to bring change in this country, and to bring law and order and a respect for the Constitution again, if I was running this, if I was Trump and saying, okay, how can we get our country back? I'd take 80 million Americans, even if half of them, and I'd go on an economic boycott. And I wouldn't spend, which is totally legal, I wouldn't spend any money on anything other than the absolute necessities. In 6 months, half of those big boy elite companies and the hedge funds and all those guys would be bankrupt. And all of a sudden, now you'd have some leverage to say, okay, that we need law and order again. We can't let these guys, these FBI guys, these CIA guys, these, all these guys that are guilty of treasonous acts just go free. No, we're not going to have the country we want for long if that happens. So I think at some point that there's going to be a grassroots revolution. I just don't see the U.S. Standing like lambs and letting us getting taken over. However, I just read something today that said the millennials are all for socialism. Yeah, you know why? All of them have shit jobs, and half of them are still living at home.
Yeah, it's easy to be a commie when mom and dad are paying the bills. Now, even with the lockdowns, a number of cities, especially Democrat-run cities on the West Coast, are experiencing housing bubbles significantly larger than the housing bubble of 2006. Does this make any rational sense?
No, it doesn't. It doesn't make any rational sense at all. The only point that it makes is that anything can happen in this world. I mean, if when the coronavirus hit, if anybody would have guessed that the stock market would go to record highs, the real estate would go to record highs, and it's not only going to record highs, the real estate market in the United States, it's accelerating. This year-over-year growth has increased for since March when the coronavirus starts. How do you make sense of that? I mean, so somehow you got to say, wow, I mean, people can do crazy things. That's for sure. But somehow you have to think it's tied into money creation with the Fed. The Fed has put $3 trillion into the economy, printed up $3 trillion and put it into the economy. Of course, who's the biggest beneficiary of that? You think it's Joe Sixpack, or you think it's the top 1%ers? I think the top 1% have increased their net worth by $1 trillion in the last year. Has the average American increased his net worth by that much? I mean, the rest of us? No. So, the good news behind that is you've got to take control of your life somehow. You just can't give in and say, I don't have a chance, because you do have a chance. You just can't fight those guys head on. You just have to be smarter than they are. And one thing, don't lose your ass, because nobody's gonna come and bail you out. So you have to take that responsibility. I mean, because all the big guys, they're all in the back pockets of the politicians. I mean, that's how they get and stay elected with their donations. And so they buy favors. And we get in trouble, we're going to get bailed out. Hell, even Warren Buffett received $30 billion of TARP money during the last financial crisis. Now, why do you have to bail out Warren Buffett?
Are we likely to see lower or higher interest rates during the Biden presidency, and what could it mean for real estate in the U.S.?
Interest rates are always a really, really tricky call. I can say this. Here's an interesting situation we have right now, divergence, I'll call it. The 10-year T-bill has gone in the U.S. has 10-year T-note has gone from about 0.6 to over 1% in the last 3 or 4 or 5 months. And normally mortgage interest rates are tied to have increased, and mortgage interest rates are tied to that interest rate index. U.S. mortgage rates are at all record lows, 2.65. So even that has broken its link, with historical tradition, Jim. So, I mean, who the hell knows what's going on anymore?
What's the latest on California real estate?
Oh, I'm glad you brought that up. California real estate. Everybody, as you know, is leaving California right now because the tax rates, we have the highest tax rates in the country. We have a communist government, that there's violence and everything everywhere, drug addiction's rampant, and yet between San Diego, San Francisco, and Los Angeles, especially Los Angeles and San Diego, and the state of California, that with those three cities. Those three cities have some of the highest price appreciation in the United States right now. So if everybody's bailing out of these urban centers like LA, San Diego, and San Francisco, where they're sure not selling their homes in San Diego and putting a glut of homes on the market that would depress prices. I think it was 2 months ago, I checked California real estate prices. Median home price in California was up 18.7% over the last 12 months. Does that sound like everybody's abandoning California for different locations? Doesn't sound like it to me. I mean, one of that I learned long time ago when I started studying markets, and I have this rule on my computer to monitor: trust what you see, not what you think. Trust what you see, not what you think. And what do I see? Housing prices are accelerating to the upside in California. Does that mean everybody's bailing out? I don't think so. So I don't know what's happening there. I mean, they say people are leaving, and I'm sure they are, but somebody's coming in and taking their place at even a higher price.
What's the latest on real estate in the rest of the U.S.?
It's all doing really, really well. All the momentum indicators are not only pointing up, but those two, in most cases, are accelerating to the upside. The worst market in the country is New York City. I mean, because whatever, it I don't have to tell you, because it just is. I mean, everybody, and supposedly everybody's moving to Florida. Everybody's moving to Florida, or everybody's moving to Texas. Okay, everybody's moving from California to Florida or Texas. How come housing prices are rising faster in California than in Florida and Texas? I mean, that doesn't make sense, but is that the reality? That's the reality. So you got to be real careful who you listen to. I mean, everybody's spouting off the things, that San Francisco is going to be, they're going to bulldoze all the buildings in the city and it's just going to be vacant land in about 20 years. I don't think so.
Are any of the U.S. housing markets flashing a buy or sell signal?
No, they're all, no, they're not flashing a buy signal, and they're certainly not, because the buy signal happened, a while back. In fact, for most of the United States, the real estate timing models that I used, flashed buy signals for like 90% of the cities I follow back in 2012, and it hasn't changed since then, Jim. So we've been on a buy signal in most major cities in the United States for 8 or 9 years now. I mean, my system's not perfect. It's only 80 to 90% perfect, which is, that's as good as it's going to get. But nothing's on a. Do you know what's on a sell signal right now? San Francisco. San Francisco's on a sell signal. The city, as a city. And even then, it's on a sell signal, and housing prices are still going upward, rising upward. But that's a little bit misleading, because they're using median prices, and median prices change with the mix, not the overall housing market. And what's selling in San Francisco are houses in the $1 to $2 million range and $3 million range, and not the low end of the range. So, the median is 50% of the homes above, 50% above. So that's bringing the median up way more than it should be.
Could we see the trend where people are selling their homes in the big cities and moving to the burbs and rural areas reverse?
Yeah, I think so. We're social human beings. I mean, look, if for example, if you were raised, I just don't see everybody in California moving to Coeur d'Alene, Idaho. I just don't see that. One, it's too far from the beach. And if you're raised here on the beach, you're going to stay close to the beach. And I think that's just a major cultural shift. I mean, let's say you live in LA and you like the theaters and you like pro athletic teams and whatever else comes with a big city. You think you're going to get that in Coeur d'Alene? No, you're not. You're going to go to sleep in Coeur d'Alene.
Well, apparently if you move to Tulsa, Oklahoma, they'll give you $10,000 to do it.
Is that really? When did that start?
Recently.
Wow. Now, what? You know what that says about Tulsa, Oklahoma? Is that a good place to live?
It is if you talk slow.
But, I mean, why do you have to pay people money? I mean, I haven't followed up with it and to get all the details, but I heard even Biden's considering giving first-time home buyers a $15,000 credit, for some reason, as a tax credit or a down payment credit or something. I mean, you can juice these markets as much as you want, but are they sustainable? Are they sustainable? It's just like you can keep a dead person, a person that's clinically dead, alive on life support. For how long? I don't know. What? Long time. Does that mean he's okay? No, he's dead. So I don't know what these guys think they're going to do here, because everything's going to revert back to normal one way or another, or they think inflation's going to bail everybody out, and that's never been the case. I mean, do wages keep up with inflation? No, they don't keep up with inflation. And by the speaking of real estate, which is my primary emphasis by a mile, I think now is a very, very bad time to be buying real estate. Very bad. Because you're paying a high price for real estate right now at record prices. Could they go higher? Yes. Of course they could. But if you look at forward returns on that, what you're going to get, based on what's happened in the past with the cycles and things, you're looking at very, very low returns. Here in California, after the last bubble burst, it took, I think it was, how long did it take? I think it took 14 years for LA, San Diego, and San Francisco to get back to break even, to get your old money back. So, I mean, that's the risk you pay at buying something high, that's something that's like extremely high, and then it takes a big dump, which things tend to do, in the last 20 years. The old days, this isn't the 50s, 60s, and 70s in the United States anymore, Jim. Where things just kind of steadily kept going up, the golden age of the middle class, just boom, boom, boom. Everything kind of kept going up. Once in a while you had a crash, but nothing like the volatility we're seeing now. Nothing. So I think there's a huge risk out there, and if people ask me like, okay, look, I've got some bucks, where do I put the money? I think you put it in gold and silver, and I think you put it in commodities. I think you'll be very, very happy with those returns in the next 5 years as compared to like stocks or real estate or whatever else your preference is.
And I can tell you the experience in British Columbia. If a government says we'll give you money towards a house, all it does is boost the house price by the amount of money the government just gave you.
Yes.
Yeah, so you're not saving anything. We'll have more with Robert Campbell when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Robert Campbell. Bob, could the executive orders President Biden has been signing in his first few days in office destroy the stock markets and the economy?
Well, I don't know how many of those executive orders are ever going to happen. I mean, I know he signed 100 of them like the first 2 days. My first question is, do you think Joe Biden read and understood what all 100 of those executive orders were in 2 days? I'd be surprised if he understood any of them. So in other words, and one of them, what was he going to stop? He was going to stop, open up the borders again. And I guess that, I don't follow this as closely as a lot of people do because I value my brain cells more than they do. But I understand, like Texas, the Supreme Court in Texas or some major court in Texas said, no, you're not going to do that in Texas. We're not opening up the borders. So there's a fight. Now there's fights going on with all these stuff. So I mean, I don't know how successful these fights are going to be against the U.S. government, but you can certainly fight these things. I know that pipeline, that oil pipeline, he stopped work on that. So I mean, just when we became, energy independent with super expensive oil, I might add, I mean, all of a sudden now he's banned the pipeline. So it just seems to me like that his sole mission is to undo everything that Trump did. That's the mission here. I mean, and where's that going to take us? God only knows. Opening up the borders. I mean, oh my God. So, I mean, and making 10,000, 11 million illegals, giving them instant citizenship. And who knows what else he wants to do with these people. I'll tell you what we're going to run into. Here's something that I'm hearing through the grapevines, through this, is that Medicare's getting in trouble. And all of a sudden, now that there's no money in Medicare, and they're starting to make things like, for people, harder and harder and harder to get, because they don't have money to pay for it. So, I mean, I'm 70, almost 74, so I've been on Medicare almost 9 years now. So whatever you got going that you see as a potential client, you ought to make sure that you have doctors and stuff, and you've been treated for it to say this is a pre-existing condition of mine, and they will continue that. But all of a sudden, some of these people, if all of a sudden you show up at age 70 and say, wow, I got this problem, Medicare could say, tough luck, that one's on you. Like, for example, Medicare. If you're an alcoholic and need a new liver because it's of cirrhosis, they won't pay for that. That's on you. So all of a sudden, maybe they just extend that to a lot of other things, and so pretty soon you won't even be able to afford health care. Medicare won't won't apply. There'll be exceptions to it. So I think the next 2, 3, or 4 years are going to be really, really. There's going to be some dramatic change in this, and I think it's going to lean toward the worse, not the better, Jim.
Is China likely to make further inroads in its quest to take over America?
I don't see why not. They got their boy in the number one seat in the cockpit, don't they?
What are your thoughts on gold and silver?
Oh, I think those are going to be excellent investments. Excellent. I think it's going to be excellent investments whether we get inflation or not, because they're not typically inflation hedges. Where they perform best is when there's economic and political uncertainty. And I think that we're going to have a big dose of that over the next 2 to 4 years, as I just said. So I think it's going to be excellent. And commodities, that up until about a year ago, they were at like a 50-year low. You want to buy things that are cheap, and now they've been performing the last, in the near term. Let me just check here and see what my charts say. I don't follow it that closely, on a week-by-week basis. But the commodity index, oh yeah, 13, and now they're up to 15. Heck, in the last 3 months, the commodity indexes have gone up like 20%. That's a bit, that sure doesn't compare with what's that firm that went up to 500 today?
GameStop.
Yeah, right. But that's a nice return. I think commodities are going to do real well because they're cheap. They're cheap. And I think that, if everything starts breaking down in the economy, like, the jobs are bad and there's social unrest and uncertainty, could I see the truckers, go on strike and all of a sudden there's no food in Ralph's? Yeah, I can see that. I told my wife the other day, I said, I'm starting to see these things. I said, we got to get on board early. I said, go buy another 25-pound bag of brown rice, and why brown rice? Because brown rice will last about 5 years. Before it'll rot. And that's good. Just have enough water and put your brown rice in it. And if all of a sudden there's no food in the grocery store, for a week or two, you're not going to starve.
And you get fiber. Does the U.S. dollar look like it's getting stronger?
No, it looks like it's getting weaker. I mean, all this money creation that the Fed has produced, that it's having its impact on the dollar. There's no way it's not going to have an impact on the dollar. You just can't create $3 trillion out of thin air, print it up, and inject it in the economy and say that's not going to have an effect on the currency. If you compare the Fed's balance sheet against the U.S. economy, it represents 45% of the annual economy. I think we only have like a $17 trillion economy, and the Fed's balance sheet is over $7 trillion. That's like 45%. That's a big number, Jim. In other words, the U.S. economy is on life support. The U.S. economy is on life support. The only way it can continue doing what it's doing is if the Fed continues to inject money into the system. The patient is in a grave situation. It needs a life support to stay alive, and in a lot of ways, that's where the U.S. economy is in. I mean, and right now, as bad as things are, the airlines in the U.S. are running at about 35% of old capacity. And they've been doing that for a year. It costs a lot of money to run an airline. How many airlines have declared bankruptcy, Jim? 0. Nobody's declared bankruptcy. They've done some Chapter 11s, but nobody goes bankrupt anymore. I think the goal is to try to is just bail out everybody. Bail out everybody. And with the amount of money that it's going to take to do that, oh, who knows what impact. We could turn into Venezuela. Everybody goes, this money's not worth shit. And they say, I just got to get rid of it as fast as I can. And all of a sudden, the velocity of that money, it starts turning over not at like 5 or 10 times as fast as it is right now. You've got runaway inflation on your hand. So could that be possible? Sure, it can be possible. Anything's possible. But all this money printing and money creation, it certainly hasn't led to what they call inflation. The inflation rate in the U.S., the official inflation rate is 1.3%. Of course, that doesn't include housing. That doesn't include medical care. That doesn't include food. Can anybody that housing's about 8, medical care is about 6 or 7, and food's running about 6. That's well below the 1.3.
And they don't include energy either.
Right.
So what are we living on? Air?
You know what? It includes everything people don't need.
Do you think the green energy sector is heating up due to the Biden presidency or the worldwide growth in electric vehicles?
Wow, I don't, you know what, I don't have an opinion on that, Jim. I really don't. I'm unqualified on that. I know he says that, the U.S. government fleet is going to be all electric, in 10 years? I mean, I don't know where at what point in time that whole green movement just comes to a screeching halt, because there's no way in the world that we have enough money to pull that off, to pull what they need to do. I mean, it's stupid anyway. Think that the U.S. by itself is going to change the climate of the world? No, it's not.
If Newsom, the governor of California, is successfully recalled, would big, medium, and small businesses be less likely to leave California?
I think so, of course. I mean, we have more rules than anybody, and especially the Democrats, The Democrats like big government, and them telling you how to run your business, how to successfully run a small business, even though not one of them has ever had the personal experience of doing so on their own. But I think that would be a big plus. I think it would be a big plus. I think it would be a big plus to get about 80% of the politicians out of office in the United States, one way or another. But I would put that Governor Newsom, at the top of the list.
Do you have any health tips for us?
Oh yeah, health tips. Okay, everybody knows that that's my primary investment. And that a buddy of mine came down from Seattle, and he's always been a real muscular guy. He's like 6 foot and weighed 200, all muscle. Well, now he's 6 foot and weighs 245 and 45 pounds of fat. So he's going to lose 45 pounds of fat in 2 months. And I said, okay, I've been trying to lose 5 pounds in 2 years and been unable to do so. So now that he's going on this extreme thing, it's really got me cranked up again. I'll tell you guys, anybody that needs to lose weight, and I just started something new, I drink a half a gallon of water a day. First thing I do when I get up in the morning, I drink 16 ounces. Then about 10 o'clock, I drink another 16 ounces. And then all of a sudden, 2 o'clock, I drink another 16 ounces. And then right before I go to like 6 or 7, I drink another 16 ounces. Why do you do that? Because it's filling. And the way I look at it, it really works. If you could eliminate the need for 200, which is not much, extra calories per day by drinking water, that's 6,000 calories a month. That means that's 2 pounds of fat, which is about 3,000, you have to have a loss of about 3,000 calories to get rid of 2 pounds of fat. And that means over the course of a year, you could lose 24 pounds of fat, theoretically, by just drinking 1/2 gallon of water a day, because it curbs your appetite. How about that, guys?
2 liters in
cool?
Canada.
I'm just so excited. I start drinking water again. You get away from it, because it's a pain in the ass to drink that much water. One, you go in the bathroom all the time. But if you want to lose weight and do it, an easy way, just drink half a gallon of water in 4 different sessions every day, and I bet you lose 2 pounds of fat a month.
Do you have any other wisdom you'd like to share with us?
I don't think so. Not at this time. The only wisdom that I can share with you, the only one thing I maybe haven't talked about before, is that the wisdom of being a successful investor, and the fact that the more you pay for an asset, the lower your future returns are going to be, and the less you pay, the higher the returns. And that's why the best way to make high returns and outperform the markets, any kind of markets, is to buy when prices are depressed. Buy them when they're depressed. And even if you're going to buy and hold, buy them when they're depressed. Don't be buying all the time. Just wait for the huge correction to come and then buy into those corrections. You will have super duper high returns with a minimum of risk if you do that. Why don't people do that? Because they have no patience. They have no discipline. They don't know what indicators to follow. That everybody's telling them, it's the fear of missing out, like that, buy now or be priced out forever, as they used to say here in California with respect to real estate. That was right before prices fell 55%, by the way. It takes a lot, to do well in the markets over long periods of time. But it's something you gotta try to do. It's something you gotta try to do. So I just become more and more, the older I get, the wiser I get. I can see the wisdom of that type of investing, which Warren Buffett, he likes to buy things when they're low. That's for sure. He's always got a big cash position. I mean, he kind of got tricked this time. I think his Berkshire Hathaway had $130 billion in cash, and the market kept going up. I think these markets have surprised a lot of people, Jim. A lot of people. That they say, is this the way it normally happens? No. Is this the historical pattern? No, it's not. I mean, and the best way to predict the future, and you've heard me say this probably too many times, is the best way to predict the future is to study the past. And I saw a cartoon today. It said, those who don't study history are doomed to repeat it, yet those who do study history are doomed to stand by helplessly while everybody else sees it repeated. So, I mean, it's a tough game out there, guys. It's a tough game to get ahead and stay ahead. But it's a magnificent challenge. You're not playing these games with this, these high flyers like, look at American Airlines. American Airlines is broke, and it's gone up like 200 or 300%, hasn't it, in the last week? Why is American Airlines going up? It's pure speculation. Pure speculation. Like one guy said on TV the other day, he said, you know what? He said, some of these guys that are trading these stocks, they would bet on 2 cockroaches racing down the side of a wall. Is that investing? No, that's not investing at all. That's pure speculation. I mean, is there any fundamental value to GameStop or something like that at 500 or 300 or 400, whatever? No, it's in single digits. So how they think this is all going to turn out, unless everybody thinks this is the next Apple or Microsoft? I mean, do you think American Airlines is the next Apple or Microsoft? No, I don't think so. But maybe that's the bet. But as usual, during blow-offs like these, most people lose their ass. They do. That's just you can pretty much count on that, and I'm sure that's going to happen this time.
How can people find out more about your newsletter and your book?
Okay, everybody can go. In fact, I'm so excited. I just changed my website after 19 years. And they can go to realestatetiming.net. Realestatetiming.net. And see the new version. Eventually, I'm going to have it changed to realestatetiming.com in the next week or so. But we put it on that server right now just to make sure it's that it works correctly. It's kind of like when when the Navy launches a new boat. They let it go out and try and see if it works and hope it doesn't sink. So that's kind of what we've done before we make it live. But you can go there. You can buy my book for $35. You can invest in my timing letter for $135 a year. And, for those of you that just want to learn how to think from objectively and rationally as opposed to emotionally, a lot of people subscribe to my time letter just because they like the way I think. I always direct their thinking back to, yep, that's the way you have to look at it. People that use data to make important decisions are way more successful in the long run than people that don't use data. That's what it comes down to. Would a doctor ever operate on you without doing a full set of tests and electrocardiograms and MRIs? Not in a million years. Do all of a sudden people make snap level investment decisions and which to buy, what they think we should be buying in all the time? And most of those people do terrible in the market. They do terrible with their money. They'd be much better off just staying in T-bills, which will bore you to death. But that's the way it is. Is that you got to look at everything from a data-driven standpoint. And anybody that reads me knows that every statement I make is supported by data. I'm not part of the guys that dwell in the I think analysis. I think. No, that's not analysis. That's just an opinion. That's just opinion or speculation. All of a sudden you say, like, I think this is going to happen because that this indicator's pointing up, this indicator's pointing up, this indicator's pointing down, or whatever the case may be. You use key economic and market indicators that are well correlated with price movement in whatever asset class you follow. And that's what gives you a head start on everybody else in determining major trend changes. And that's a big advantage. It's a huge advantage. So there's your edge.
Bob, thank you so much for being on This Week in Money.
Thank you. Bye.
My guest has been Robert Campbell, publisher of the realestatetiming.com and realestatetiming.net newsletters. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Rick Ackerman, and Robert Campbell, and thank you for listening. If you have any questions for our guests or the show, you can send them to info@howestreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Thanks, Jim.
Larry, 2 news releases from the company this week. What's in them?
Well, the first release was regarding the initial results that we got back from Cometco on the testing of the Wenden strategic stockpile, and we were really happy with them. We had up to 88% recovery, and I just want to explain that to everybody. That is initial assays, and we expect that with some jigging on the sample size and grinding and everything else that we can increase that, and we'll have something hopefully next week on that. So moving on, we have, of course, our listing on the pink sheets on AMY.V, and now we're uplisting to the next level where we'll have a bid and ask on the stock, and we think that'll help tremendously in the attracting investors out of the U.S. So those are great things. But the big story this week is what's happening with the Robinhood traders and the Wall Street, and it's quite interesting. Firstly, I'd like to mention that people, at least the paid predators on the board for AMY, used to, bitch slap me every time I talked about the fact that we were getting shorted and predator trading. And now that's come to the forefront. Everybody's learning about predator trading. they're seeing this happening on Wall Street, and so that makes a big difference. Now, the one thing I talked about going back 8 years was the crash in 2008 on the New York Exchange, and that crash was generated by heavy-duty shorts on everything. I think Fannie Mae and Freddie Mac and brokerage houses going from $50 to 50 cents. I mean, that's egregious. So eventually the SEC put a partial rule back in whereby you couldn't short a stock down more than 10% in a day. I don't see that rule as being very effective because we know that we are shorted down on the OTC market. We get shorts of up to 70% of the trades. If it's 4 million, then it's close to 3 million are shorts, and because they have to report those. But going back to the main board, which is our TSXV.V listing, there is no short rule. Nobody talked about it because they didn't, basically, they didn't even want the investors to know that they could get shorted into oblivion. I did. I was concerned for our shareholders, and I was also concerned for the market in general. And the market went down from 2011 when they first announced that they were going to be getting rid of the short rule in Canada, and went down from there I think it hit a low of 300 here recently, and it started out at 2,400. And if that wasn't a fall over the cliff, I don't know what is. So that piqued my interest, and that's when I, through a lot of investigation and a tip from one of the newsletter writers that the short rule was gone. And so, I attended several meetings that were involved on why the exchange was going down. They called it regulation and strangulation by regulation and all that. And I tried to point out to them it wasn't that. It was the fact that the stocks were getting shorted, that there was no requirement. No short rule? Where's the requirement to borrow? No short rule? Where's the requirement to report the shorts that are out there? And I felt there was at that time a tremendous amount of shorts, and we did trap them. In 2016, when we got our first results from the work that we were doing on lithium-ion batteries, and our proof of concept came out, and the stock shot from 2 cents to 35 cents, and rapidly taken down to 15 to 20, and eventually settled in at 20 cents. But that was a new level for us. We raised the money we needed by our shareholder base, and a few new people coming inside to buy the stock. They liked the story, and the story is solid. So we did raise up to $10 million and progressed the project to where it is today, and it's almost complete on the testing at the pilot plant with this new and that we're doing on the catalyst, or the cathode material for, particle size. That should be, when that's over with, we can turn our attention to the design and solid costs of what it's going to cost and what we have to get fabricated, blah, blah, blah. But the interesting thing is that nobody was interested in what I was talking about, the fact there was no short rule in Canada. And, I'm talking about other companies, investors, everybody glazed over when I talked about it, but it's significant. And now it's showing up with what's happening with the Robinhood traders and their fight with Wall Street. And that is certainly, there's one stock in particular that's out there. GME the actual stock is GameStop. And they've been shorted to 140% of their float. So how does that work when there's only a rule that you can only take a stock down 10% in a day? You tell me, how can you short stock that you can't borrow? And they certainly have that requirement in the U.S. where you have to borrow the stock. Well, 40% of that stock is just out of the air. And the Robinhood investors recognized this, and they moved into with one of their basic operations, Reddit. They moved into buying up the GameStop, and now they probably bought 140% of the float. So they can't even get delivery on that 40%. So this is huge. I mean, the predators took the whole market worldwide down in 2008, and now it looks like Wall Street's circling the wagons and to protect them from the traders, the Robinhood traders. You know, a lot of these guys are trading, maybe $1,000, $500, and right up to $1 million. And, they've recognized a weakness in the market. And, so they're not a hedge fund. They're not a, big fund. They're not a brokerage firm. They don't have deep pockets. So, they get together and they buy up the stock. You've seen spikes in all over, the U.S., and certainly we've seen spikes on the Venture and Toronto Stock Exchange where they have gotten involved. Now, what I'm thinking is that we do know that we've got some Robinhoods coming into our shares, and I think that our short position is quite large. I mean, if you look at, if you want to take a good example, look at the OTC markets. Those shorts are coming from the TSX exchange, from traders and brokers and individuals that short sell the stock and try to even out their portfolio on the Venture exchange. And of course, there's no rules. I mean, we had articles written and published by papers like the Sun here in BC, which is one of the largest papers around. And, talking about this short rule, we called it the Wild West at the time. And now it looks like, they're restricting the Robinhoods from buying or selling. And, this is affecting a lot of people, and there's a tremendous amount of people. We've gone through a period where people have lost tens of billions of dollars just on the Venture exchange. And, companies have disappeared forever. Companies that had deposits have new ownership because, basically the original company, couldn't pay its bills, disappeared, and now these assets are in other people's hands. What I'm saying, guys, is I'm just saying that I feel that finally people are recognizing what I started to talk about 8 years ago was exactly what was happening out there, that the big funds and supported by local banks were shorting the hell out of the Venture exchange. And certainly I know I'm a fundamentalist. I knew that there's something wrong, something was broken, and when I identified that the short rule was gone, I can also identify that there's not a lot of short covering coming in on the stock from that the Robinhooders are buying. So just more shorts. And so that's something that I'd like to look into, and I will be following. And but it's an exciting time for us. I mean, certainly I'm validated by what's happening in the market now. People are starting to recognize that these predators are really there just to take your money and put it in their pocket, break the company so they don't even have to buy it back. And that's kind of what's been happening. So now that it's exposed, it gives us a little better area to come back and fight from. So I would wish everybody a great weekend. I think it's going to be exciting on Monday. And, like today, we hopped up to $1 and down to 90 and back up to 97. And, market's not even closed yet. So have a great weekend, everybody.
Larry, for people new to American Manganese, what's the company all about?
American Manganese is a critical metal company that developed a process for treating very low grades of manganese for the critical metal, one of the most critical metals in the United States. They have no production of it, and they have to look at, like they did back in 1950, that they had to get some manganese stockpiled, and that manganese we're working on as we speak. It's a strategic stockpile at Wenden. But the interesting thing is that the manganese patents are the cornerstone of our recycling patents, and we've been very, very transparent about that. We, it goes back to my days of when you're doing a feasibility study or a PIA or a pre-feasibility, that you have to have people working on it that are experienced, big engineering firms that cost a lot of money, but are arm's length to the company. And all our results are arm's length to the company, and we're proud to, to post news releases on what Cametco's done. And we're moving that one right along, and that one is looking fantastic, in my opinion. And so these are areas that we feel will build the company in the future. And we're starting to get a price that's worthy of what our accomplishments were. I mean, stuck at 20 cents. Guess who was holding us down there? But now we seem to have broken out of that. Maybe the next level will be higher. And I can't mention numbers because I'm not an analyst. Anyway, I think it's going to show increase of interest, people buying the stock, and the ease of financing. So I would like to say that we're very happy with our progress.
Larry, where are you traded, and how can people get more information about the company?
We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. Under the symbol AMYZF, and which, by the way, we are uplisting that I mentioned earlier, to where we can get a bid and ask on the stocks, which will bring in more investors out of the U.S. And we're traded in Frankfurt under the symbol 2AM. So we have a website out there, AmericanManganeseInc.com, and we have contact information on that website, and all the due diligence you want to do. Don't do your due diligence on the billboards, because I've lost a lot of shareholders that held the stock to all that crap that they were putting on there, the bashing and everything else, and calling a young guy like me to getting old. I mean, gee whiz, I'm only 76. You can also phone me at 778-574-4444, or you can email me at LREAUGH@AMYMN.com.
Larry, thank you so much for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on January 29th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.